Hello there. Thank you so much for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions, and we will have a question and answer period at the end of today's presentation. Use the chat box to ask those questions, and if we're not able to get to your question, go ahead and leave your phone number and email as well in the chat box, and we will make sure to reach out to you after today's event to make sure that gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Mark Seither is a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He is a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual in La Jolla. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial minded helped him thrive as a financial advisor. As Mark honed his skills as an advisor and a planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. He found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders, a retired Navy and current Southwest pilot, to build Kingsview Partners. Together, they assist individuals on wealth management and tax strategies, specializing in the specific needs of pilots. And Mark, I'm excited to have you here today, and I'm going to go ahead and turn over the time to you.
Perfect. Thank you, Marche. I love how in your disclosure you clarify that any opinions and jokes are not advice chasers. Is your way of saying like, hey, any terrible joke Mark makes, that's on him. So.
Absolutely. That's all on you, Mark.
Present joke included. Hey, everyone. Very excited to go into this topic today. My business partner is a pilot, and we also co-manage a book of business in wealth, doing wealth management. And a little bit about me. I mean, you heard my bio, but to tie things in specifically to the tax topic is when I joined Trust CFO doing the trust administration for advanced planning, which trust administration sounds about as interesting and as that title, right? Really did get some exposure to how a lot of our successful clients that we were doing asset protection and wealth management for, their keen strategic move was their tax planning, right? It was about finding ways to get money that's on paper to money in your pocket as efficiently as possible, right? And so the keen strategic move of getting taxes or getting money that's on paper into your pocket as tax efficiently as possible, that was really a focal point of making a big difference, in the financial plan in general. So working with a lot of pilots. Again, my business partner is a pilot. This has been something that we've addressed with clients, especially with anyone who's getting that 16% contribution to their 401k. You can, it's an awesome benefit. It's awesome, right? But we really do try and get people to start looking at how do we get funds to our pocketbook tax efficiently. So now, something to point out here is that, we with pilots, we meet a lot of them that are great savers. They're living well below their means. They're putting a lot of money away, but without a plan on how to spend that money, right? Which in my opinion is far more fun than saving, right? I'd rather spend than save. But without that plan, they really don't have a retirement plan, right? They have savings vehicles. They have ways that they're putting money away, but they have no idea how they're going to get that money out. If you don't know how you're going to get that money out, you have no idea how much you're going to net, and you are susceptible to unfavorable tax situations, right? You are a stroke of the pen away from tax codes changing, taxes either being added or increased, that all of a sudden you're like, well, I need to take more money out of that account to net the same amount, and there's very little flexibility there, right? And we'll I'll give you some examples as to how this plays out, but really to touch on kind of a psychological piece first, it's very easy for our brains to ignore the tax drag that is on our wealth, right? And what I mean by tax drag is, if you work with a financial professional, you probably get a statement of, hey, here's your annual rate of return, right? To give a little dig in my own industry, they probably picked a benchmark that's lower, right? To show you like, hey, look, benchmark says 8, you got 10. Awesome, right? And so if you're looking at your money on paper saying, okay, well, I had a $500,000 investment account. I got a 10% rate of return. I have $550,000. $50,000 created. Awesome. That's amazing. I'm excited over that, right? I'm excited over dollar tacos, right? It doesn't take much to get me excited, right? But $50,000 just created out of nowhere. That's amazing. If we're not paying attention and we spend $25,000 more than we needed to that year in taxes, right? Not, hey, could we cheat the tax code in a certain way, or could we lie, do something, fraudulent, right? Not that, just if we did things that we accidentally spent $25,000 more than we should have, or that we could have, well, you just ate up half of that impressive $50,000 gain, right? Now, the psychological piece is you can easily not look at that tax bill, and you can easily just go look at your 10% rate of return and still feel good about yourself. You can, basically get that dopamine drip of like, good on you. But if you were to be honest with yourself, or if a CPA was to be honest with you, they'd say, well, no, you actually, you have a $25,000 issue that we really should have addressed prior, right? Now, the second way that taxes can erode wealth is people get into what I call the tax deferral trap, right? Now, the tax deferral trap is, it's based on, it's based on, I don't want to say mostly truths. I mean, they're whole truths, like taxes are painful today, right? If you're at a high tax bracket, like defer, defer, defer. Here's where you fall into a tax deferral trap, though. Is, let's say you're getting your 16% non-elective contribution to your 401k at the airline you fly with. You're deferring another, $20,000, right? You're trying to see how far you can kick the can down the road. Well, eventually you kick the can and there's just no more road, right? Like we can't kick the can down the road. And now when you're looking at that $4 million 401k, you can't tell me how much belongs to the IRS. You can't tell me how much belongs to your state. And you actually don't know where the risks lie in potential creditors, right? Now, 401ks luckily have very strong asset protection, but if you're planning on using this as any legacy plan, you lose that asset protection, right? So that might not be the case for some of you. I I know people, I have, I know some people, their retirement philosophy is I want my last check to bounce, right? No money for anyone else, but some people do want to leave something behind, and that becomes a concern as well. So, I mean, to give you an example of how this is played out, some people we know is, we have a client who's done very well for himself, and prior to meeting us, he was defer, right? Max fund the 401k, cash balance plan, qualified money up the wazoo, and he avoided a lot of taxes that way. Wealth grew, and that's great. But then he retired, realized that retirement was really boring, and he went back to work part-time, right? He also had invested in, some things that gave passive income, and turned out that he didn't really need as much money as he thought from his 401k. And then at the, he gets to the age to where the government says, well, you have a required minimum distribution. And after he's pulled everything he needs, after he's lived, after his bills are paid, and he's just coasting through December, he gets a calculation run for him, and it's, okay, well, we need to take an extra $65,000 out of this account, and you get to stroke a check to the IRS. And he lives in the state that just loves taxes. He lives in California. And so he gets to write a giant check to the IRS, California State Franchise Tax Board, on money he doesn't need, right? And so that's a good example of, you can easily have money that was on paper that is now leaving your pocket, right? Now, the required minimum distributions, forcing someone to take money that they don't need, can also, it can also push you to that higher tax bracket that you're trying to avoid, right? If you're in a 22% tax bracket, as of this recording, right, and that required minimum distribution pushes you up to the 32% tax bracket, well, there's a double kick in the shins, right? No one likes that. But then the other thing that could happen in your tax deferral trap is you have an unexpected expense. This also happened this year, where someone was like, hey, I have an emergency and I need $25,000, right? Because of their income situation and the event that happened, they're like, I just need an extra $25,000. Well, they only had accounts that, qualified accounts that they could pull from. And so we had to basically run it through, we explored all the options, and we basically said, okay, well, if we do this one, we're going to be selling about $38,000 worth of assets, so that after you've paid your taxes, you have your 25 net. Now, having a $25,000 emergency is not fun. Unplanned $25,000 you're going to spend. Having that $25,000 cost you $38,000 on paper is even more painful. Now, luckily, this wasn't their scenario, right? But I'll take it one step further. There are also people in that same scenario where they just took huge losses, right? This is one of those situations, right? 2022 is one of those situations where, if you had a $500,000 account and you lost 20%, so you're down to 400,000, and then all of a sudden you realize you got to sell almost 10% to just net your measly 25,000 on something you didn't even want to spend. That's what I'd like to call a bad day in the office, right? So those are reasons why not having a retirement plan where you've planned for your spending can really backfire in those later years. Now, this next topic is not so much going to apply to those who want that last check to bounce, right? If you're like, I want to spend all of it, that's great, and there's nothing wrong with that, right?
However, most people do want to do some giving, leave to their heirs, or
charitable planning, right? Charitable planning, heirs, any of that. I mean, it is common for people to have that included in their plan, right? Something with that tax deferral trap also is, right now we've got an abnormally a larger than usual estate tax, right? Commonly referred to as the death tax, right? But if that drops, or when it drops, right, because it's scheduled to drop in 2026, and if they lower it more than it's scheduled to drop by, right, that just plays more of a factor. You're looking at 40% of whatever's beyond that threshold going, being taxed at 40% of whatever's beyond that threshold, right? So to keep the math simple, we'll just assume that, the threshold is $10 million. And let's say you have invested in real estate, you've done very well, you live below your means, and you have $10 million to the penny on your non-qualified assets. Well, that means that your $4 million qualified plan, that basically pushes your estate to where $4 million is going to be taxed at 40%. And then the recipients of your inherited funds go and pay income taxes on top of that. So it can, for anyone who that is something that they want to plan for, it's also a very good topic to touch on, like, hey, what is the tax bomb that could be here, and how do we potentially not get around that, but plan for it, right? It's all about planning. So
before we move on, we got another good question. And Mark, can you explain the difference between what a qualified and a non-qualified asset is?
Yeah, so your qualified plans are going to be your employer-sponsored retirement plans, your 401ks, your 403bs, your cash balance plans, right? Things where if I make $200,000 and I put $20,000 into my 401k, that's going into a qualified plan. It's, if I'm funding the pre-tax 401k, it's going into a pre-tax, it's going in there before any taxes are taken out. So when I report my earnings at the end of the year, or not at the end of the year, because no one files on December 31st, right? But when you're reporting for the previous year, you're going to show, oh well, I made 200,000, but I made 180 because 20,000 went over to this account. It's not taken as it's not reported as
right.
income.
So that's subtracted from your income.
Correct. So that is that's going to be the difference between the qualified and non-qualified. Now non-qualified, that could just be a brokerage account, or we could go down a couple different avenues there. But really, that's what we're really looking for is those qualified accounts, and mainly planning for how to spend out of those qualified accounts, because those are going to be very tax sensitive. Right.
So you're paying taxes in retirement to take money out of those qualified accounts.
Correct. Because it's technically called that deferral. It's the full name, right? It's a salary deferral. So at some point you're going to take that money out and you're taking your salary out. And so now you've got to pay taxes on that salary like you pay taxes on your salary today, right?
Hey, if we answered that question, let us know. If you need some more explanation of that, let us know in the chat. We're happy to pause and give some more explanations.
Yeah.
All right, go ahead, Mark.
Yeah. So really we want to look at your big variable here, right? Your big variable obviously is the IRS, right? The tax man. And like I mentioned before, if you have $4 million in a 401k, you have no idea how much is technically owned, or technically due, because if you liquidate all of it in 1 year, or you liquidate it very slowly, that's going to change the rate at which you're taxed, right? So the rate at which you pull money out is going to affect that, but also if all of a sudden they raise taxes, right? Now to net the same amount, you got to pull more out. And because of that, it doesn't take a mathematician to see that, okay, well, if all of a sudden I need more to net the same amount, or pull the same amount and get less, then that's going to affect that date at which I can officially walk away from the workforce. And pilots, you can't fly a day over 65, commercially. So So really, you just need to make sure like, hey, I'm not in a position to where if all of a sudden I'm getting less money out of there because more is going to taxes. If it's like, okay, well now you're projected to retire at 70. Well, how are we going to make money in those last 5 years, right? So that's the big variable and the way we plan for this, right? So everyone should be meeting with a CPA, right? I'm not a CPA. I have a near and dear spot in my heart to CPAs because, when people find a really good CPA, they typically say like, oh, my best friend, right? They refer to him as their best friend because they're like, none of my other friends saved me that much money. So meeting with your CPA and looking at, okay, so here's our 4 tax focus points in your plan, right? You should also be doing this with your financial advisor, and a good financial advisor should be in communication with your CPA, right? They should be working together. You should all have, coordinated meetings, but you should be looking at, okay, so within my plan, what is going to eventually be taxed at ordinary income, right? Because I don't want to scare you away from the qualified plan, right? I mean, you have one, you're getting that, for those who are working for, certain airlines, you got that 16% going in there, and they're great, right? It's just, we don't want to be a one-trick pony. We want to have a couple different things. We want to look at capital gains, right? There are going to be some things that are taxed at either 0, 15, or 20%, depending on how long we hold the asset. There's going to be some things that are tax-free. Now, I should say what I mean by tax-free is you've already paid your taxes on it, right? So it's, when people say tax-free, there is a caveat there that, well, you paid your taxes. And so we just want to make sure we're paying taxes appropriately and planning for that appropriately.
And we had a question here. What is can you give kind of an example of what a tax-free account would be?
We are getting to that in just a few slides.
All right. Thanks.
Love the attentive man. If you get this many people excited and asking questions about taxes, I mean that's a good webinar right there. I mean I have to watch myself because when I get excited I start to talk fast. So I could probably do this in about 15 minutes if I let myself. And then so you got your tax-free accounts, and then the next thing that we want to look for, and this is where the strategy part comes in, is any opportunity for strategic conversion of taxability. Now, that could be taking some things from part of your balance sheet to strategically move them and offset tax consequences from a different maneuver. That could be taking things that are pre-tax and converting them into a Roth, right? So a Roth is one of those tax-free vehicles. Right now, something that's very popular is, we have some people who are like, hey, I'm doing a backdoor Roth. And just showing them like, hey, here's why we need to be, why backdoor Roth should, be thoroughly planned for, right? Is because if you say, hey, I've got $50,000, I'm just going to do a conversion of $50,000. I actually had a pilot say like, hey, I can do a Roth conversion. Should I just convert $100,000? Right? It's going to be $100,000 tax free. And it was like, you're in a really high tax bracket. No, right? Because you're going to show your income plus $100,000, and you're going to owe taxes on it, right? Whereas if we have some opportunities, and it might just be 3, 4, 5 particular points within your career, where it's, hey, you're actually in the 12% tax bracket this year because of things that happened. And you have about a $50,000 gap. You could take $50,000 and move it over, convert it to a Roth, and only pay 12%. And that $50,000 could grow to be, $200,000, $300,000, and that's going to be tax free now, right? So that's an example of those strategic conversion of taxability events, right? So to go into a little bit more detail, so your ordinary income tax, you're going to pay your federal and state tax brackets, any pre-funded qualified plan, any active passive income, and by that, that typically means real estate, right? If you have rental properties, it's passive income, but it's not, but it's taxed at your, you work with the CPA on identifying the taxes. One of the reasons, and this is not a webinar about real estate, so I'll limit myself to this. But one of the reasons why real estate can be very useful is there are some ways that you can take depreciation or take losses or work with charitable planning to leverage this highly in your tax planning and use this in those strategic conversions of taxability events. So that's the end of my real estate section of the webinar. Earned wages. So if you do, some part-time work, if you have royalties or interest income, right? So if, those are all going to be things that are taxed at ordinary income. Capital gains, these thresholds get adjusted, but if you open a boring regular brokerage account, or you buy an asset at $10 and you wait 365 years, not 365 years, 365 days, right? If you wait 1 year and then sell it, you'll pay a long-term capital gains tax on the growth of that asset. So if you bought it at 10, it grew to 20, you'd pay, depending on where you fall in the different breakpoints, either 0%, 15%, or 20% on that $10 growth. Also some opportunity in there for the strategic conversions. And then short-term capital gains, this would be if you were to sell that asset for less than a year. So if you were to buy it at 10 and 6 months later it's 20 and you sell it, you're going to pay your highest, you're going to pay capital gains tax, your highest income bracket on the growth of that 20. So those are, that's a little bit deeper dive in the capital gains discussion. Tax-free, you got your Roth IRA, Roth 401ks, right? Big misconception here is people say, hey, I make too much money to contribute to a Roth IRA, and so they don't contribute to their Roth 401k. That income limit does not exist for Roth 401ks. You can make as much money as you want and still put money into your Roth 401k. There's cash value life insurance is an option. I'd say that one gets debated a little bit. I'm not here to debate it. My opinion on tax-free planning is there's many ways to develop it. So develop it a way that you're comfortable with, right? Potentially muni bonds is another way. And if done right and if done within your plan, these can be very useful tax-free revenue streams, right? And then the strategic conversion of taxability is, I mentioned the Roth conversion already, right? So finding a year where you're like, hey, we are in a low tax bracket for this reason or another. Let's go ahead and take some money. Let's do the calculation and take money from our pre-tax account and convert it over to Roth, right? Get the blessing from the CPA, get the right calculations done, but that's absolutely doable. You could take accelerated depreciation. So working with the CPA on maybe if you have real estate or some other, other investments outside of Wall Street, you can, not everything depreciates on the same schedule, and some things allow you to take depreciation quicker than other. That's both accelerated depreciation and cost seg studies. Cost segregation study looks at, hey, and this is where finding those one or two opportunities makes sense, is, we'll work with the CPA and they'll say, well, if we take this depreciation in this year, we can really offset this big balloon we have over here, right? In which, instead of kicking the can down the road, you're essentially saying, hey, IRS, go ahead and tax me. By the way, I have all these tax things I need to reduce it by that I'm choosing to take this year, right? So you're choosing to do a particular event and reduce taxes that year. Charitable planning. I've done webinars and podcasts with Ed Cotney. He's a great charitable planner. Very, I have his ebook. It's a great. It's called The Tax Secrets Made Simple, and it's just a great summary of different types of tax planning, and it touches on the charitable side of how this can really get money that's on paper to your pocket very efficiently. And then this one, I had to stay vague because it's very situational, but there are also instances where you can invest money and leave your gains in the investment and take your principal out. Right, I gave you that scenario of I sold, I bought something at $10 and it grew to $20. Well, what happens if I take just my $10 that I originally put in there? Well, that's not taxed. So you start creating, that's you kicking the can down the road. But going back to strategic conversion and taxability, maybe you're like, I can afford to kick the can down the road because I have this other event that I'm planning on doing to offset this eventually. Now, to put this in retirement terms and retirement practicality, I kind of want to walk you through a scenario where, let's say you took the can kicking strategy, you deferred everything, it's in your 401k, you have a very healthy 401k, and you're not going to not retire, right? You're likely, you're likely not in a situation where you're not going to retire. And you say, okay, well, I need $200,000 a year to live and have fun. So we take $200,000, take it out of your 401k, you report $200,000 of ordinary income, and you take a standard deduction of whatever it is that year. Let's say $25,000. So okay, well, I took out $200,000, took a standard deduction, and I'm left with whatever I have after tax. That's one way you can do it. If we were to look at a true retirement plan where we, again, spent more time on what Mark likes to plan for, which is spending money, right? Then we would say, okay, well, let's take $25,000 out of your 401k first. And this is just a hypothetical situation. This isn't like, what I'm recommending anyone do is like, hey, this is what you should do. I'm just pure hypothetical. But let's say, okay, let's take $25,000 out of your qualified plan. You're thinking, well, you told me that I want to stay away from that. Or we got to be careful with that. It's like, yes, but we're going to take that standard deduction and, we've taken out the same amount we deducted. We're at zero. Now let's say, okay, well, I told you that in that capital gains, I'll back up real quick. In the capital gains, there's certain thresholds where you're either paying 0%, 15%, or 20%. Well, let's say we work with the CPA and we're looking at, okay, well, we can pull $35,000 out of this non-qualified account and be within the 0% long-term capital gains tax. So now we have $60,000 totally tax-free. Now let's say that over time we funded a Roth 401k and we did some Roth conversions. And you're like, well, now I'm going to take $40,000 out of my Roth. So now we have $100,000 and we have yet to pay taxes on this, right? Maybe a little on the long-term capital gains because there's some states that, again, conversation with the CPA, right? CPA is always involved, but we're getting to where we're pulling to really minimize that tax. And then another thing I didn't really throw in here, but go ask your CPA, if I have $200,000 of reported income, how is my Social Security taxed? Because if you're showing no income, or if you're showing very little income, it's taxed a little bit differently. And Social Security planning gets very convoluted and definitely takes some strategic retirement planning, but that also plays a factor into, okay, well, if we're able to pull things to where now we're minimizing that tax, I mean, just in those 3 steps alone, I just showed you how, $100,000 could come out at minimal, almost zero, if not zero taxes. Now, the rest, the 200,000 you needed was gross, right? So we don't have to fill up to the next 100,000. I mean, you could be like, sweet, I just need another 50, right? But we're starting your tax brackets on $1 after we've pulled that $100,000, if that makes sense. We've pulled money out without you showing money on your income brackets. And now that last remainder, we get to pull out and from a reported income on your ordinary income tax is going to be much lower, right? And the other thing to think about is then when you have those emergencies, right? If you have an emergency and you're paying a 10% or 12% tax on that versus a 30% tax, you have, if you're like, hey, Mark, I need $25,000, instead of that very large number of like, okay, well, because we have to go pay the tax man, we're gonna have to liquidate about $38,000. We could be looking at like, okay, we need to liquidate about 27 to 29,000 to get you 25. That's a much more palatable number. And it's because you didn't pigeonhole yourself in, hey, if I need $1, I've got 2 higher priorities before me, right? It's the IRS, the state, and then me. You're able to control that a little bit. And that's really, in my opinion, that is the strength of a retirement plan, right? Investments, right? Allocation, risk management, all of that stuff, it doesn't take that away, but the strength of a plan is building it in a way to where you get some control over that. You get some control over how you spend your money, your taxability. You have some flexibility to where it's like, hey, tax rates changed. This just went up. Maybe we got to pull some more from over here, right? We kind of have different things that we can draw from. And, that's going to put you in the best situation to where, if you come to me at age 63, right? And you're like, hey, I'm retiring in 2 years. If those other things aren't really built by then, it's very difficult to build it, in those last 2 years. Not impossible, but very difficult and limited. If your mindset going into building your wealth is, how do I spend this? How is it taxed? And in what situations is it possible to pull off some of these strategic conversions, right? And pull off some of these tax strategies. That's the queen on the chessboard, right? That's your power player, in my opinion. And I think that often gets lost when people have, 2 things: the dopamine of being a good saver. They're putting money away, living below their means, and they're doing great. Their balance sheet is going up and to the right. That's what we all want. They just might not be putting it in places that are advantageous down the road. But then also by not looking at the tax drag and by looking at their rate of return and saying, hey, I made the $50,000 and I'm just choosing not to recognize the $25,000 that I sent out the door that I didn't need to, right? By ignoring that component, you can put yourself in a position to where, like I said, most people aren't going to, not retire if they do, a few things correctly, but are they going to retire in a way to where they can be more flexible around tax code changes? They can leave more, in charitable planning or legacy planning. They can have some more control over how much and really when they retire. That's a huge part of the planning and spending money aspect that I think every pilot, really needs to be taking a good hard look at, especially with the very generous, contributions some of these companies make to your 401k. It's, hey, they're making generous contributions. Let's figure out how we pull money out at some point. So.
All right, well, we've got a chunk of questions that have come in, and so I want to go ahead and get started on those. I will tell people as we're addressing these questions, if you have a question, go ahead and leave it in the chat. And even if we don't have a chance to get to it, we're happy to reach out to you and make sure that gets addressed. So here's a good question. Can you speak to contributing to a traditional 401k versus a Roth 401k? I understand the benefits of tax-free growth of a Roth 401k, but how should we think about contributing to a traditional 401k if we don't know what our income will be in retirement?
So
there's a couple questions there.
Yeah, there's
a
couple questions in there. So really, when looking at, hey, should I be funding a pre-tax or a Roth? One of the things we look at is, okay, the probability of you retiring in a lower tax bracket, right? So there are some people who plan on, absolutely retiring in a lower tax bracket, and they know exactly how they're going to do that, right? In which maybe it does make sense for them, right? The other thing we also look at is the breakdown of your balance sheet. So, I had someone recently where, it was a pretty easy decision for them where I showed, I was just able to show like, hey, you have, they had, I'm not sure if I'm getting the first two correct, but it was roughly, 25% of their assets were in qualified plans, another 50%, or not 50%, another 70% were in non-qualified plans. And then there was just about 5% that was in a Roth, right, or Roth 401k. And it was, hey, we're not really balancing out here, right? You don't have very much wiggle room in your Roth to where you're going to be able to, again, that's a matter of like sitting down with your wealth manager and your CPA and saying, hey, this account, by the time I go to retire, how much am I going to be able to draw down from? If it's not very much, then that's, that might be a good indicator that, hey, maybe we should build up some more tax-free funds in the Roth. The other thing, is, we're at some pretty low tax rates today, right? Even the people who are feeling high tax pain, we're at some low rates today, and so, there is the element of, well, do you pay the devil you know, right? You know that 16% is going to be taxable in retirement, so do you go ahead and pay some of that today and give yourself that wiggle room? So that would definitely be an individual, case by case basis. But those are just some things to think about is, am I going to have any or enough to even defer taxes, to have some tax-free money for 1 or 2 years? If not, maybe I should spend some more time thinking about that. And then also, is it worth paying the devil I know? Because, if you're of the mindset that in retirement taxes are going to be higher, it might be good to have some money you already pay taxes on.
All right, here's some more questions and still kind of going in the same theme. So I have a Roth 401k option with my employer. They also offer a match. In general, our employer matches added to the taxable accounts, not the Roth.
So in general, and because 401ks are a pretty tricky animal, but in general, your employer's contribution is going to be pre-tax. If you log in, you're going to see, their contribution accounted for separately. Your contribution is going to be in their Roth. Now, I will say, if you're doing, we'll say, 4%, right? If you make $100,000 and you're doing 4%, right, that's $4,000. Some people say like, well, aren't I saving less money if I do 4% in a Roth because it's after tax? The 4% is always going to be, it's going to be based on your gross amount. So it takes you, you feel that 4% a little bit more, but you're still, if you do 4% in your 401k and you make $100,000, whether you do it in the pre-tax or the post-tax, it's going to be, that $4,000 number. And then the employer section is going to be pre-tax. Now, some do give you the option to convert their contribution after they've made it, but you're paying the tax, not them. So.
Okay, so the employer match, you're eventually going to have to pay the taxes on that.
Yes, whether you pull it out in retirement or convert it, yeah.
Okay, all right. And then this is a great question. How do you convert, not how do you, they asked, at what time do you convert a traditional 401k to a Roth IRA? Do you do it while you're working, as you retire? You said a couple points in your life. Can you talk a little bit about when you can do that Roth conversion?
Yeah, so I try and plan for both, right? So if you can do it while you're working, awesome. If there are going to be years, and for anyone who had to take time off during COVID, right? that may have been a good year to say like, hey, I made less money. I wasn't working, I was furloughed, and I was at 50% pay. Great year to take 20, 30, whatever your CPA and wealth manager break down as a safe number. That's a great year to do a conversion while you're working. Just make sure that again, you're calculating the taxes and there's no surprises, right? Now, the kind of the apex of what we shoot for is, hey, if we can set things up to where when you retire, you're still giving yourself some room to do some conversions, right? And like for instance, right now there's a jump at a certain income threshold from 22% to 32%, right? And so we're giving people planning options towards like, hey, if we can pull enough money from various things and keep you in a certain tax bracket, then every year we're going to try and see, okay, do we want to pull future you, and future you could be just 3 years down the road, 4 years down the road. Do we want to pull 20 grand for them and go ahead and pay taxes on it now? Because we know it's only going to be 22% and we're okay with it, right? So that's also a, if you can build a retirement plan where you can factor in like, sweet, I'm going to retire, and every year I'm going to try and do a couple Roth conversions along the way. That's going to do two things. One, it's going to give you that control over taxability, right? Two, that's going to reduce your eventual required minimum distribution. So that person I talked about before who was like, man, this is a real fun Christmas. I get to write, a giant, who gets the most for Christmas? The IRS in California. Like that's not who I want to bless on Christmas. So for them, if they had done conversions, right, and paid tax preemptively, that calculation is based on your total balance in that account. Well, if you're doing conversions along the way, right, you're hopefully reducing that account, and that's just gonna, they don't make the calculation easy. I can't tell you like, oh, it's 5%, it's a complex, it's a not something I can rattle off the top of my head, but it's definitely something where if you can reduce that number over time when you hit that required minimum distribution, especially if you retire at 60, as of the time of this recording, that required minimum distribution, you got to start thinking about, it's going to start hitting in 12 years. It's like, what can we do in 12 years to get some of that account into something else and reduce that balance? So.
Great question there. If we have not answered anything that you're curious about, go ahead and leave some more information in the chat. I have another question here. Are there certain benefits of a Roth that are not commonly known, and such as if you die before using up much of your retirement funds in a Roth? Talk to us a little bit about that.
So that's so if you die and you don't spend all of your money in a Roth, right? That's basically when someone gets an inherited IRA that's taxable. Very common mistake. It's illustrated in Tax Secrets Made Simple, right? Where someone gets a $300,000 inherited IRA, and they're like, sweet, how much can I pull out? And technically, all of it. You're just going to show 300,000 of income. And so they pull out all of it, they spend all of it, or, and someone, I know of someone who used it to go pay off, debt. Well, then they got a tax bill and they're like, well, wait a minute, I'm in debt again. Like I didn't, because they didn't, they didn't plan properly. And, so for the Roth, it's, it's tax-free, right? It's tax-free, it's, there's less stress from that standpoint. So that's one benefit that, I try and stress, like, hey, if you can have, if you can have $1 million, it's 100% tax-free, right? And that's $1 million, you don't have to worry about, okay, what's mine, what's theirs, to me, that's a huge benefit.
Mm-hmm. All right, so are there any other benefits of Roths that are not more commonly known?
Well, you know, Roth 401ks and Roth IRAs are two different things. So on the Roth IRA side, there is some like, hey, after some has been in there for X amount of time, you can pull out this amount without penalty, right? I'll go into opinion, Mark, real quick. I get very hesitant about people who learn about how something can be used and then try and use that. You know, I've had some people who are like, oh, so I started doing that, you know, and I'm planning on using that for my kids' education. I'm like, why are you using retirement accounts to plan for education, right? Why don't you use education planning? You know, so to me personally, I'm like, just because you can do something with a Roth, right? There are those benefits of being able to get some money out tax-free, or I shouldn't say tax-free, penalty-free, you know, prior to 59 and a half. For the you know, I'd say probably the biggest mistake I see people making is they associate the Roth IRA with the Roth 401k, right? And they are two different things. They have the same R word at the beginning, but like you can't, as of this recording, roll a Roth IRA into a Roth 401k. You can roll an IRA into a 401k, but in 80,000 pages of tax code, something, you know, it can get a little convoluted, and a Roth IRA can't go to a Roth 401k. A Roth 401k can go to a Roth 401k. Roth IRAs have a lower contribution limit. Roth IRAs, if you make too much money, you can't put money in them anymore. Roth 401k is not the case. So really knowing the difference, because some people just rule out Roth, you know, anything with the word Roth in it, and they're like, oh, well, I can't do it, I make too much money, right? Or I'm, you know, I had one person in particular, they said, hey, I'm max funding my Roth 401k at $6,000. Like, well, that's not max, right? You can go much higher than that. So that's, you know, hopefully that answers that person's question.
That's great to know the difference between those two. Well, I have time for about one more question, and actually we'll probably take two more questions here. This is a question to clarify what you said about doing multiple conversions to a Roth. Do you create a new Roth account for every conversion, or does it go to the one Roth account?
Nope, just goes to the one. Yeah.
All right, I hope with that we answered that. All right, this is the last question we have time for. So if you're in your 30s and 40s, when do you really need to worry about doing these tax implication planning? I mean, that's the accumulation phase. So most people are thinking, maybe I don't need to worry about it till I'm in my 50s. Can you talk a little bit about that?
So my very biased tax sensitive brain says yesterday, right? Like, when is the best time? Now, I'm not going to fault anyone if they've left that off the to-do list, because I can think of very few things that are more exciting to the general public than tax planning, right? I mean, less exciting. But you know, really for, you know, and I kind of alluded to that in that, you know, example where if someone came to me at, you know, 60 or 62, right, and they're like, hey, I'm retiring at 65. What can I do? Well, we've kind of lost the 20 to 30 years prior where there may have been opportunities along the way, right? And, you know, there's really, you know, probably just going to be a few actual transactable, you know, events where you do one of those strategic moves, right? It's not going to be, hey, every year I'm making some mind-blowing thing. It's, hey, every couple of years something might get on our radar, or we might plan for something and say, hey, this in 10 years, this is when we're going to do X, right? So the longer you can give yourself, and really, you know, I try and make the tax conversation as simple as possible, of saying, okay, we really need to review what your ordinary income tax situation is now and what it's going to be if you keep doing what you're doing, right? We need to review that long-term capital gains piece, review the tax-free piece. Once we know those three, we can start focusing on, here are the different types of those strategic moves or those strategic conversion steps. when they fall into play, sometimes we can plan for them and execute them on the day we plan for them. Sometimes they pop up. Sometimes we plan for them and the tax code changes, so we have to tweak them a little bit. The more time you can give a CPA and a wealth manager time to adopt and mold your plan to the ever-changing tax landscape, the better suited you're going to be for, for giving yourself. I mean, really, it's just about creating options, right? If you're the person who ends up with just the one option of I've got a taxable account and that's it, very little flexibility we can do there, right? But if it's, hey, so this year this changed, because this changed, we can make this small change, right? Or we planned for this and we plan to do this, at this transaction point, and we're here and let's execute it. And yay us, we did what, we were able to do that strategic piece. The more time you can give your team, the better they're going to be able to prepare for stuff.
All right, that's about all the time we have for questions. I want to thank everyone who has participated, and I want to thank Mark for being here. Mark, why don't you go ahead and go to the next screen? I can show your picture again. And we want to thank the organizations that have made this webinar possible today. For our attendees, look for an email soon with a link to the replay of this event. I know there's been lots of information shared, and it's good to review and make sure that you've got everything covered there. You're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Thank you. Bye.